Good afternoon, and thanks for joining us for today's webinar, Tax Cuts and Jobs Act, Tax and Valuation Implications of a Sunset versus an Extension. So, could be exciting stuff coming up here. My name's David Blain. I'm a partner here at McKonly Asbury. I'm the director of the firm's Entrepreneurial Accounting Solutions Group, and I will also be today's moderator. And presenting with me today also is partner Eric Blocher, also director of our Valuation Services Group, and another one of my partners, Jeremy Peachey, who is a tax partner. If you are not familiar with us, McKonly Asbury is an accounting and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia. We offer a wide range of services to organizations in various industries. For more information, please visit our website. And you can see the website right there at the bottom of the page there in the overview. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations, as well as current information through our blog. And we do a lot of blog posting, so there's a lot of blog information that's out there. All right, big item here. Pay attention if you're a CPA. There's going to be CPE polling questions that will pop up on your screen. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during the webinar. For those of you that are looking to obtain CPE credits for today, please keep in mind, pay attention to this now, keep in mind that there will be 4 polling questions throughout today's presentation, and you must answer all 4 questions to get your certificate via email within a month after the webinar. In order for attendees to be eligible, you must answer via the polling submission, and we will not accept late responses. So we will keep the polling questions open as much as we can, but the first polling question is up for everybody, and that is, do you wish to receive CPE for attending today's webinar? So I would assume Eric Blocher and Jeremy, you need CPE, so you're going to be looking for CPE in today's webinar, correct?
Always, yes.
There we go.
Absolutely.
There we go. So, all right. So I would imagine, I was going to say 92% is yes. We got a few that are out there, and they're just excited to listen to Eric and Jeremy tell us a little bit about what's going on the tax side. So, without further ado, let's move right into the objectives for today. So again, the objectives are going to be to obtain an understanding of tax implications of the sunset provisions or of the sunsetting of the TCJA provisions, obtain an understanding of what those impacts would look like from a value perspective on your business, obtain a better understanding of valuation theory in general, and Eric is going to take us through some basic understanding on that. And then questions and comments are always welcome. So please submit those questions and comments again in the chat box, and we will take a look at that. So first item of business, I'm going to turn it over to Jeremy, and Jeremy is going to give us a little bit of background on what the TCJA looks like versus what the previous tax code looked like, and what those differences might look like. So Jeremy, without further ado, I'll turn it over to you.
Thanks, David. Appreciate that. And so we're kicking off here with just some items that we want to consider as we want to understand how we value a business. And one of the first things we have here are personal provisions of the TCJA. And you might say, well, why are we looking at personal provisions? Well, I thought we were talking about business valuations. And really the reason we want to do that is because most of the business tax revenue in the US is reported through pass-through entities. I think it's over 51 or 52% of all tax revenue is coming through the pass-through business, and those pass-through business income is taxed at individual rates, and so that's why it's really important to understand what these rates mean from an individual standpoint. And kind of the headline grabber is, pre-TCJA, the top rate was 39.6%, and that was lowered to 37%. And you might be thinking, well, that's a nice reduction. But if you kind of peel back a little bit and then you look at the next 2 rate tiers, it's 35%, the next tier down for both pre and current tax law. So you might say, well, the second rate didn't change at all. And then if you look at the third rate down, it only was reduced by 1 percentage point from 33 to 32. And so now you're thinking, well, there's a lot of tax revenue that's generated on those top rates. Probably about 53% of all adjusted gross income in our country. It comes from tax revenue from those top three rates. So those top three rates are really important when we're looking at what could happen here in this year, whether these rates go back to where they were, whether they stay the same. The other thing that we want to consider is standard deductions. With TCJA, the standard deduction was doubled basically for both single and married filing joint taxpayers. And if these provisions expired at the end of this year, as they're in current law set to do, they would go back to the original standard deduction rate. The other item, if you remember, we used to have personal exemptions, and that was a dollar figure per individual dependent filing in that tax family, if you will. And those are at zero currently, but those would go back to the normal levels adjusted for inflation in this upcoming 2026 year if the TCJA provisions expired. So these are all things that we want to contemplate as we want to understand how do we value businesses and how these things would impact the tax expenditures for our business income as we're valuing it.
Yeah, and they also, this is Eric, they also impact the business as an owner. And that's one of the things that, Jeremy's going over. If you're an owner of a pass-through entity, then these personal income tax change provisions from the TCJA impacted your bottom line tax, not just your business, but also you. And these are kind of interrelated that you'll see later in the presentation, that it comes back to some of these changes. And I remember when these first came out, these changes, and the whole valuation community was going through with a fine-tooth comb and looking at the provisions that had changed, which ones impacted the business owners, which one impacted the business, and then we all had to see how we were going to account for things. And we'll hit on quite a few of these other valuation-related issues later in the presentation.
You can go ahead to the next slide. So some other key provisions that changed, the child tax credit was increased significantly. It was around $500 per qualifying child, and now it's at $2,000. That would go back to the old rates. The next item, state and local tax deductions or SALT deductions. This is the area that's getting a lot of press, a lot of discussion around the conversations in Congress about tax extensions or provisions or sunsetting. Prior to TCJA, state and local income taxes could be deducted, basically dollar for dollar as an itemized deduction on your personal tax return. And that included income taxes, real estate taxes, as a variety of other, business type occupational taxes. And what TCJA did was cap that at $10,000. And so there's a lot of discussions right now about, should we increase this to $20,000? Should we increase it more? There's even ideas floating around of, if you're a non-business owner, maybe we'll increase it. But if you're a business owner, maybe we'll leave it at $10,000. And the reason because for that process is because a lot of states have instituted what's called a pass-through entity tax. So the business is able to deduct the tax at the business level before the income is taxed at the individual level. And so these are all things that are going to impact the valuation calculation that Eric just mentioned, because these taxes, state and local taxes, are directly related to the business operations and the cash flows that are generated from the business. The next item is the mortgage interest deduction. This was also limited or capped. The overall indebtedness that in order to take the interest deduction is capped at $750,000. So if you live in a area that has really high residential purchasing costs, you're probably limited to what type of interest you can deduct on your Schedule A, your itemized deductions of your tax return. And so this is an area that, if it would sunset, would provide some additional tax deduction relief for folks in some of those higher metro areas where cost of living is higher.
Yep, and Jeremy, one of the things from a valuation perspective that is interesting with the reduction in the pass-through income tax brackets. One of the things that we were challenged to do as valuators is we need to account for the taxes for the pass-through entities, because even though the entities themselves are not taxed, the owner, the investor, the holder of the shares of stock or the ownership in the company, they're going to pay tax on their pro rata share of the income that comes through. But from a fair market value perspective, a standard of value, that's the standard of value that's done for all estate planning valuations. We as valuators have to do that and assume that the buyer and seller are hypothetical. And if you think this through, you aren't supposed to know who the buyers are. So how do you know how they're going to be filing their taxes? As a pass-through entity, are they going to be filing married, filing joint, single? All of those implications, and decisions have impact on the effective tax rate that you're going to do, and that you should be using when you're doing the valuation. And because of the TCJA changed the rates, we had to think about how we wanted to address that. And in the industry, there were people just using, this is an average rate across the country. And I wasn't quite comfortable with doing that. So what we do here is we look at an estimated income that might be coming in for the ownership interest, and then do an effective income tax rate calculation based upon each individual filing status. And then we take an average of those two effective rates to come up with an estimate. So at least I can explain how I'm determining, the effective income tax rate that I'm using. And it's not the marginal rate, because you get the benefit of the lower rates as you get up to, the higher rate class. So it is an effective income tax rate, but you really don't know how you're going to be filing it. So the implications here and the state and local tax deduction limitations also impact the tax rate that you're going to be having as a pass-through owner. So all these things were important to the individual, and they're important to how you're going to value a company and determine an effective tax rate. Thanks.
All right. Polling question number 2. I hope everybody's paying attention here. To honor Easter coming up in April, which of the following is the greatest Easter candy? Is it that classic, old-fashioned, hard, full of chocolate bunny? Is it the cream egg there, or is it the Reese's peanut butter eggs? So Eric, which one do you go with?
Well, the chocolate bunny would be in play back when they were solid, but then some genius decided to save money and make them hollow, and I didn't like that.
Yeah, Eric, I was thinking the same thing. That's off my list. Mine is the Reese's peanut butter egg.
Exactly.
And anybody who knows me around this office will probably attest to the fact that the Reese's peanut butter egg is not a surprise for them.
Yeah, when I was a young kid, I would watch those Cadbury cream egg commercials, and they were so slick and had the rabbit and the bunny and the lion making noises. And I wanted to go out and get those. And every time I did, I regretted it, because I tried to eat it. I'm like, should have gotten it.
What about you, Jeremy?
Well, I like the chocolate bunny, because you can get one that's like 3 feet tall, and you can have it for a long time.
You're right about that. Yeah. Yeah.
Make
a good point, Jeremy, and make a good point. Well, I think let's see what we got here for responses here. Okay, there were 57% said the Reese's peanut butter egg, and the 23% for the chocolate bunny. Not as much on the Cadbury egg. So
that Cadbury thing.
All right. Moving on, I think we're going to continue on with some other business-related tax topics. So I'm going to turn it back over to you, Jeremy.
Thanks, David. Now I want some chocolate. So just as getting into some of the business provisions of TCJA. So one of the items that was made permanent that's not going to change is the C Corp tax rate. And so that was lowered from 35% to 21%. And along with that, some states have also started lowering some of their rates. States are always kind of very fluid with their tax regimes, and they're changing rates. For those of you located in Pennsylvania, the Pennsylvania business climate for C Corps has always been, a very high rate at 9.99%. And now that's being reduced over the next 7 years here or so to an end rate of 4.99. So the rate for C Corps is beginning to come down quite a bit nationwide. And some people are going to start thinking, like, should I have a change of my business structure because of tax rates? And that also impacts how we value a business. It's also interesting to note that even though C Corp rates are lower top line effective rates, the tax revenues in our country, only about 8% or so of tax revenues are coming from the C Corp regime areas. So it'll be interesting to see what happens here post this calendar year, whether people would want to change their structure or look at how they're taxed from a business standpoint. One of the other key items that was added to the TCJA tax law was what's called the qualified business income deduction, and here we're talking about what qualified business income is, or QBI. And so what that does is it allows an additional 20% deduction for any qualifying business income that is passed through to the individual. And this was really done as a way to kind of level set the higher rates at an individual level for business income versus the C Corp rate that was now lowered to 21%. And so if you think about it, all this income from a pass-through business owner, whether you're a partnership or an LLC or a S corporation, this income is passed through to the individual. And as long as the individual meets certain limits of income, of how much wages they're paying to their employees versus the amount of property that is in the business, they're able to deduct an additional 20% off that business income, which is a fairly powerful deduction for the small business owner. Now, there are certain industries that this does not apply. Unfortunately, us accounting folks, this does not apply. It doesn't apply to attorneys, financial services, some other types of consulting businesses.
We had bad lobbyists, apparently.
Yeah, well, yeah, we do. That's all I'll say. But overall, this is a fairly powerful deduction for business owners, and I think, as Eric has mentioned already, it most likely had a fairly sizable impact on the valuation calculations and projections that we have to do in order to come up with that value for the business.
I would agree. Now, there were some interesting situations that you had to consider. Now, when this first came through, like I said, the valuation community got together and tried to figure out, how you were going to account for this. For the C corporations, it made it a little bit easier because it was a permanent change in the tax rate. But for the pass-through entities, it really made it challenging because the law as we know it and knew it since it was enacted is that it will sunset at the end of 2025. So what we had to do for pass-through entities is we basically had to adopt a discounted future earnings approach because we would have to show different tax rates. We would have to show the tax rate where QBI would be applying and reducing the pass-through rates, similar to what I mentioned a few minutes ago. But then in 2026 on, the rate would sunset back to 2017 rates, which would be higher. And what that did is it made us have to project out several years of activity to account for the change in the tax rates, which we have to assume are sunsetting.
And that's why it makes this conversation about whether any law change that comes into play, is it going to be permanent or is it going to be limited to some type of time horizon, whether it's 8, 10, 12 years? It really impacts how we value a business.
So true. Okay, next slide.
Okay, just again, a reminder, business pass-through income taxes are taxed at individual rates. This was what we talked about on the first slide as we kicked off. And again, just as a reminder, most of the business income in our country is taxed at the individual level through pass-through businesses. So those rates are really, really important in how we think about these things. The other interesting thing, bonus depreciation changes. For many, many years, bonus depreciation was either 50% or 100% expensing of any capital expenditures, any capital that was put into the business and used in the business. And then with TCJA, there were a number of years where it was 100%, but then it started in this kind of toning down the expense, so to speak. It was phased down to zero in 2027. And so in this year, in 2025, we're only able to expense up to 40% of any capital, qualifying capital that is put into the business. And so this is one area where, Congress has always kind of played with the percentages and what we're allowed to deduct from a depreciation standpoint. And it also, again, significantly impacts businesses, particularly that are very capital intensive, that have a lot of cash flows that are going to improving plant and equipment or upgrading, certainly with technology. And as we think about robotics or other technology-driven equipment, it's becoming very, very expensive and costly. Even software that certain industries use in their everyday business activities have gone up in price. And so these things are all something that we need to keep in mind as we look to project valuation, future cash flows, and how we can expense those items that we're adding to our business in our operations.
And Jeremy, they can elect to not take bonus depreciation as well, correct?
Correct. So you can elect out of bonus. It's a proactive election not to take bonus, and so you could depreciate any property over the life that is within the tax regulations. Whether it's 5 years, 7 years, 15-year property, you can depreciate that in a way that is prescribed in the regulations. And Section 179 is still available too. That's not here on the slide, but Section 179 is also a method that businesses use to can elect to choose to write off 100% of their expenditures for capital purposes, as long as the business qualifies. There are certain regulations and rules. You have to have positive income, and there are limits on how much property you can put into service each given year. But there are other methods to depreciate your property. The nice thing about bonus is that it's very easy, and there are less rules when it comes around to when the property is disposed of, as well as income levels. And so it just has become really a kind of easy way of business owners planning for their cash flows when they buy a piece of equipment and they think in their head, well, I can deduct X percent this year, and then I can worry about next year and my capital expenditure budget.
Yeah, and all things being equal, if you take bonus depreciation, that is going to increase your cash flow immediately because you're paying less in tax. So by electing bonus depreciation, you are having a higher cash flow immediately, and due to the time value of money, value is going to go up, per se, if you have a steady stream of capital expenditures. But I know some companies that have estate planning, emphasis where they don't necessarily are looking for an increase in value, so they've elected out of bonus depreciation. So that is something that you can do and should be factored into the valuation then too. Okay, next slide.
Okay, so now one of the things, the state and gifting exemptions. So this was almost doubled, pretty close to being doubled with TCJA, and there was a lot of proactive planning around the what ifs if this exemption goes back to pre-TCJA levels, which would effectively cut it in half. And so there is some consideration to this. I mean, my personal opinion is they're probably going to leave this alone. They're going to figure out a way to extend this. But it also is something that we consider as we consider gifting, as we consider setting up different arrangements for ownership of our pass-through businesses, whether we want to employ any other types of estate planning with trusts or gifting to the next generation. And these are all areas that impact how we do valuations and how we account for the value of stock given who owns it and who controls it. So this is a very important area that we need to consider. And if it would be reduced or cut in half back to pre-TCJA levels, there would be some significant other areas we would have to plan around in order to get valuations where we would want them to be.
If you have a taxable estate above this level, then we're seeing a lot of activity with the estate planning attorneys trying to get enact their estate plan to take advantage of the exemptions while they're still high, and they know it. They don't want to take a chance on speculation that it might get moved down. I don't know that it will, but if they do a lot of that, if they do the gifting in 2025 while it's still set up, then you can make sure that you take advantage of it. And there is a lot of estate planning activity going on this year. So I would encourage anyone that was interested in this to talk to your attorneys now and get a plan in place, because come year end, I think it's even going to get busier, and you may have some firms that might not have capacity to get the valuation work done. So I'd say do it early to get in.
Okay, this next one more slide, one item back, please. So this last item here on this slide is the treatment of research and experimental or R&D expenditures. So this was an area that, when TCJA first passed, this was buried in there, that any type of expenditures around the research and development or coming up with new ways and ideas of doing things would have to be capitalized and amortized over the next 5 years if it was based in the US. And so we all thought that this would be something that would be amended, or Congress would rewrite the rules, and they didn't. And so for the last number of years here, we've been helping taxpayers and businesses understand what they should be capitalizing, amortizing, and it has had a significant impact in taxable income, the amount of cash that taxes have had to be paid because of R&D expenditures. And it has really been a difficult area for certain business owners in certain industries. One of the areas is technology software companies. Software is one of those things. There's constant innovation, constant new ways of doing things, and it's one of the areas that really has to be looked at with a fine-tooth comb of what should be capitalized, and there's more that should be capitalized than we realize. And so when you really dig into these rules, it can be quite a tax surprise for a lot of business owners. And this was a permanent change of TCJA, so it is not scheduled to expire at the end of this calendar year. Now, there has been a lot of talk in Congress over the last number of years to try and amend this or redefine it in a certain way, or even take it away altogether. So time will tell whether this is something that will change, but it'll be interesting to see what happens, because this area of the tax code is becoming quite burdensome to a lot of taxpayers, and a lot of taxpayers don't realize that they are part of this area of regulation where they need to be capitalizing costs. So it has caught a lot of people off guard, and time will tell to see what Congress does with this one.
Yep.
All right, going ahead, next slide. Just some final things here. Net operating losses, we're offset to 80% of taxable income, and you no longer can carry them back, but you can carry them forward indefinitely. So that's impacted how we look at cash flows, and also how we deduct interest expense. So there are certain rules that if your business is over 25 million in revenue or even more, as inflation adjusted, you're not required to do interest expense deduction limited. But if you are over 25 million in revenue, then you need to start looking at how much interest expense I can deduct, and that'll also impact your taxable income and the tax outflows that you're expending each year.
Yeah, and that's something we've had to model into our valuation and analysis for highly levered companies. If they are over the revenue threshold, we have to look at that to see, because it can impact them negatively with a cash, from having a higher taxable income, because they can't deduct the interest expense and higher tax outflow. Okay, next slide.
All right, here we go. Polling question number 3. To honor the Masters here in the next week or two, which of the following is the greatest golfer? Is it Tin Cup, Happy Gilmore, or Carl Spackler? I'm running Carl Spackler. Jeremy?
I'm a Happy Gilmore guy. I mean, you
Happy
just
Gilmore
you can't beat
Eric?
Oh, I'm Carl Spackler. Cinderella guy. Cinderella
What a
story.
great movie.
Got to go Carl Spackler.
All right, we'll give everybody a few more seconds here to answer this question.
And you realize we're dating ourselves, because some of these movies are fairly old.
Well, Carl Spackler, you're talking about, that's 1980, right? 1980,
Yes, that's the
81.
80s. Yep.
Yeah. So, all right, let's take a look at the polling results. Oh, Happy Gilmore gets 69% on that one. And Carl Spackler comes in at 20, Tin Cup 11. Okay.
I think Happy may have gotten some credit for the fight with Bob Barker, and that he was using a hockey stick sometimes. So
yeah, exactly.
That's
all right. Well, let's keep moving on here, since we're already halfway through and we got a lot of valuation basics to go through. So, Eric, I'm going to turn it over to you.
Okay. Yeah. So what I'm going to go over now is a few of the valuation basics, which should give you an understanding of things that come into play in every valuation, and then also, in particular, the TCJA made us look at some of these things in more detail. And first thing, essential to business evaluation is that it's a forward-looking exercise. It's an expectation of future cash flow. It's the same as any other investment. When you look at the value of a business ownership interest, you should look at it just like any other investment. You're looking at the cash flow that you're going to get in the future. The past can be looked upon to help predict what's going to happen in the future, but you're not going to pay for the past. You're going to pay for the cash flows that you're going to get in the future. It's based upon what we know as the data valuation. So given the TCJA had provisions that are scheduled to sunset and they'll impact future cash flow, as I mentioned earlier, we had to model out the changes based on the expected sunset provisions. And when this started happening, this was multiple years out. If we were doing a valuation in 2018, we had to model out to 2026 of the activity so that we could capture the change in taxes, because as of then, the tax rates. Now, this is what's interesting, though, is because we were modeling out, the lower tax rates, and then at the end of 25, going into 2026, we would model out what the income was, and the tax rate most likely would jump because they would go back to the pre-rates in 17, which didn't have the QBI deduction. So for the pass-through entities, they saw a dramatic increase in taxes, but the C corporations didn't have to be projected out that much until Pennsylvania changed their corporate tax rates, and that comes into play a reduction, as Jeremy was saying, from 9.99% down to a much lower rate that ends in 2031. So when we're valuing a C corporation, we have to still model that out to 2031 when the tax rate settles, if it's a Pennsylvania C corporation. So to address all of these things, we've done a discounted future earnings approach. It's adopted. It's the best way to address the changes. We can model out specific facts and circumstances depending upon what we're looking at. We can model out if the company is going to take bonus depreciation. We can model out if the company is going to grow, or decline in revenue if they have high debt. We can model out if the interest expense is not going to be tax deductible. We can model out the tax rate and impact with that. So it's an important thing that with the TCJA, it made us look at how we were going to model out the future cash flows. And in almost every valuation that I do, it's a discounted future earnings approach is at least one of the methods, because we're modeling out the future cash flows. Next slide. Okay. The other thing is in every valuation, time value of money is always considered. It's the present value. A dollar today is worth more than a dollar next year, or a dollar down the road. So what we do is we model cash flows out and we discount them back to present value to help us arrive at the value of the business. Now, an interesting thing that the valuation community discovered and thought about is that one of the methodologies that you can use to value businesses is looking at transactions that have taken place for ownership interest or businesses that are operating in the same industry or similar businesses. And you could say, okay, this business traded at an EBITDA multiple of like 5. But when TCJA was approved, the whole tax structure changed. And what that did is that made us say that, well, we can't look at transaction multiples in the past under old tax schemes because they're not factored into the new multiples, which new investors or new buyers are looking at. So for a while, we couldn't even use the transaction data until we had enough data that was transacted or businesses sold under the TCJA, because then we had at least on equivalent tax structures. And so for a while, you couldn't do it. The guideline public company transaction method could be used a lot quicker, because those public companies are valued forward-looking, and the multiples and the tax changes were factored into the expectations and the share prices there a lot quicker than it was for the transaction multiples. So for the longest time, multiples under the guideline transactions were unreliable. We couldn't do it. And if they sunset back to a different tax structure and it's not extended, we're going to be in the same situation where you're not going to be able to rely on multiples. Now, if we're saying it goes back to 2017, I don't know if 2017 transaction is more recent enough to use. It might be under the same or a similar tax structure, but it's not current. So I don't know that we would be able to use a guideline transaction approach, as well. Next slide. Okay, a few important other things here. The Gordon growth model, this is a simple equation, but what it does is it gets some important things into play with valuation, where we were looking at the present value of the future cash flows. That's the time value of money. And you have two parts. You have the numerator, which is the expected cash flow, and you have the denominator, which is the risk or the required rate of return and the long-term growth. And so to keep it simple, it's the cash flow on top and the denominator on the bottom, and they'll help determine the impact that TCJA can have on value, because the required rate of return factors in taxes, so it impacts that on the bottom, but then also your earnings are impacted by taxes. So depending on which way TCJA, if it extends or gets cut off, their earnings are going to go up or down. So this is an equation to keep in mind when we're looking at the impact that it's going to have on businesses. Next slide. Okay, now we'll go over some implications. Okay, now the reduction in the C corporation taxes is permanent. So if it sunsets for a C corp, it's reset to 2017, there's a tax advantage then to being a C corporation, because the tax rates for a C corporation are permanently extended, but the pass-through entities are now have higher rates with higher marginal rates, but the biggest impact is that QBI deduction is not there. That 20% QBI deduction was done so that it was leveling the playing field with the C Corps and the pass-through entities. And then also in July with the C Corps, we mentioned this before, but in July of 22 is when Pennsylvania enacted House Bill 1342, which reduced the corporate net income tax from 9.99 to 4.99 by 2031, and the reductions began happening in 2023. So for the implications for the C Corp, we still have to calculate a different effective income tax rate every year until 2031 if you're a Pennsylvania C Corporation, because the tax rate is changing every year. And that also means you need to calculate a new weighted average cost of capital, which is impacted by the income tax rate every year. It's the correct way to do it. It makes it a little more difficult and challenging, but it's the right way to value the cash flows that you have going through. And as I said before, the primary way to handle this is through the discounted future earnings analysis. So we can model out, the weighted average cost of capital each year. We can model out the income tax rate each year with these factored in. Okay, next slide. Yep, so we're going over that the 20% QBI deduction was, like I said, it was done to even the playing fields between C Corps and pass-through entities. But if it sunsets and disappears, the tax laws reset to 17, there could be a tax disadvantage then, for being a pass-through entity because you have higher tax rates, even considering the avoidance of the dividends tax. Now, this is something that we factor in when we're valuing a S corporation is that unlike a C corporation, if a C corporation, they pay individual corporate and income tax, but if they distribute out dividends to an owner as a return on the investment, there's still a dividends tax that is paid. As a pass-through entity owner, you are avoiding the dividends tax because you can make a distribution to yourself if you still have a basis in the company and subject to some other tax laws, but you aren't taxed on the distribution. Say if you owe taxes at 30%, you can make a 40% distribution to yourself, and then you would only be taxed on the 30%. The extra 10% is a return on your investment and reduces your basis. But even considering that you have some basis or some advantage with that, the difference between the tax rates still could make it that the S or the pass-through entities, S corporations, LLCs, partnerships are at a tax disadvantage level. That's what I was going over here. They basically result in higher taxes, less cash flow available to the owner, and that is, if you think about the equation, less cash flow. The very top of the equation is a lower value. So the increase in taxes could be significant and lower the values of the company, lower than where we're factoring in right now, because at least currently we were still factoring in some lower income taxes until the transition back, the sunset back to 2017 rates. They've generally been accounting for the anticipated sunset of the TCJA provisions, so it would not necessarily to decrease the value of a pass-through entity when it has already been factored in. So, you wouldn't necessarily see a big change if they were doing it right and factored in, but all other things being equal, now it's permanent. And you would have if it all sunsets back to 2017, the rates are high, as we know, for the whole way out, so you're not getting an advantage of a period of time where the rates are lower. Now, if the TCJA is extended and pass-through rates remain lowered and the QBI deduction remains, I think the value would increase because an increase in the tax rate for years beyond 2026 was already being shown. So you would have a situation where the values would go up because you would have a lower tax rate considered, which means more income to the owner from 2026 and beyond. Next slide, please. Okay, estate tax exemptions. This can be the most, I think, the biggest impact, as we were talking, because these are big numbers. The possible reduction in the estate tax exemption amounts, are the driving force behind a tremendous amount of activity that's been going on and anticipated to go on in 2025. It started last year as families and business owners who had potentially taxable estates realized that it could go away, and they started enacting their plan so that they would be able to gift and transfer ownership interest to take advantage of the exemption before they would go away. The potential, as we talked before, the potential reduction in the exemption from 28 million to 14.5 million is a difference of $13.5 million in potential lost estate tax savings with a possible estate tax rate of 40%. That's a $5.4 million estate tax to be paid if the exemptions were reduced and haven't been filed, if you haven't used them up while they were available. So it's a significant amount of cash and loss if you do not take advantage of the estate tax. So that's why there's such a tremendous amount of activity going on right now. Okay, next slide. Interest expense. Like I said before, the TCJA imposed a limit on the deductibility of interest expense at 30% of EBIT, which is earnings before interest and taxes. Highly levered companies can exceed this limit, resulting in higher income taxes, less cash flow, and lower value because you can't get the full deduction from the interest expense. The deductibility of interest expense should be modeled out using the projections and the discounted future earnings method that we talked about, and known in anticipated debt amortization. And that's something that not a lot of people consider. But when you're projecting out future cash flows, you should consider if you annually finance a certain percentage of your capital expenditures, then that needs to come in because that will be part of your projected income tax expense going out. So what we do is we get amortization schedules for all the existing debt of the companies that we're valuing, schedule that out, and then also project out and run amortization schedules on what the anticipated or projected borrowings would be. So it gives us a full picture of what the interest expense is on an annual basis, and then we can calculate to see if it's over the limit and how much would be limited and how much that impacts the income tax for cash flow. Now, a sunset of the TCJA could result in an increase in value to a highly levered company just from a reduction in income tax expense if they're allowed to fully deduct the interest expense that they've been limited to claim. So, and I have seen that with some of my clients when I've been doing valuation work, we have had limited interest expense deductibility. So if that goes away, to some degree there would be a clawback in value. Next slide. Bonus depreciation. Okay, the sunset of the bonus depreciation would have little impact going forward because it's set to only allow a bonus depreciation percentage of 20% in 2026. However, if the bonus depreciation were extended, like for a similar time frame as in the initial TCJ or extended permanently, the resulting reduction in income taxes could be material, resulting in greater cash flow and increase in value. But sometimes, the goal of estate and tax planning is not to have necessarily a higher value. So you could elect to not take bonus depreciation and have a lower value as part of the estate planning plan. So the time value of money always comes into play in all valuation. It makes it so that the cash flow and value perspective is and can make sense to take all bonus depreciation available if you're looking to get a higher value. So it depends on what your goals are, but it can impact value if you take it to a positive manner, or if you don't elect to take bonus depreciation, it can reduce value because it just reduces your depreciable depreciation expense and increases your income tax expense. Okay, next slide. Okay, polling question number 4, Dave.
Yep, polling question number 4, and this is probably the one I was most interested in, Eric. To honor the baseball season and opening day, which of the following is the greatest baseball player? Is it the great Hambino? Is it Roy Hobbs, better known as the Natural, or is it Kelly Leak? And Eric, I think this is really simple. It's Roy Hobbs. I don't know if you've ever saw the movie The Natural, but some of the home runs he hits in that movie are just incredible. I mean, just absolutely incredible, especially that one part in the movie where he finally gets to hit and practice. He hits that home run, knocks the cover off the ball. That was amazing.
Yeah, that was pretty good, Dave. But I'm going to take a different stance on this. I'm going to go with Kelly Leak. A 13-year-old that's smoking a cigarette and riding a Harley and batting about 800. Hitting dingers, and then he's a air hockey hustler too.
Yeah, you might be right. What about you, Jeremy? Anything you want to throw in there?
I was going with Kelly Leak.
You're going Kelly Leak too. Okay, well let's see what the results are here. All right, we're going to wow, it was tight between the Great Gambino and Roy Hobbs. So, all
The
right,
Great
now
Gambino wasn't great. That was a great movie.
I feel like I got to go home and watch The Natural now. So,
Don't
all right.
rest on the Sandlot.
Yep,
So.
exactly right. All right, Eric, we'll turn it back over to you. Run through a couple examples. We're coming tight on time here at 2:50. So we'll run through this and get this thing to some questions.
Okay, so what we're going to show here is a couple slides that look at the impact on the weighted average cost of capital if the TCJA is sunset versus extended. And what this is every business is financed from two different sources of capital. Some of it's interest-bearing debt and some of it is stockholders' equity. Each of those have a different required rate of return. So you combine the percentage of the financing from debt and equity times the rate of return, and the fact that the income taxes or the interest-bearing debt, assuming it's all deductible, is some of it's tax deductible. So you have to tax impact the interest-bearing debt. If it's extended, that means if currently the QBI is in place and the tax rate for pass-through entities. Now this is assuming the pass-through entities because the C corps don't change. That rate's permanent. But for pass-through entities, if this is extended, the tax rates would be approximately 29% here. That calculates into a weighted average cost of capital of 16.42%. We have long-term growth. These are all factors that were in the equation I showed you earlier. Next slide. This will show the old law. If it sunsets, it's the same interest-bearing debt percentage of capital of 25%, 75% equity, the same required rates of return of 8% and 20%, a different tax rate of 40%. So the discount, the weighted average cost of capital is actually lower. The percentage, the weighted average cost of capital changed by 1.36% just by the change in taxes. That's factored in, and I'll show you the impact that this will have, and starting on the next slide. Okay, and this is two different scenarios. The first one we have here is that the scenario one, it sunsets. It means that the tax rate goes up to 40%. The only thing that changes in these two examples and scenarios are the purple shaded cells. We have normalized net income before taxes of $4.2 million. We have normalized depreciation of $2.5 million. We have the estimated income taxes of 40% and 29% if it's extended or if it sunsets. We have normalized annual capital expenditures of $2.5 million. We have normalized annual interest expense at the 8% of $1.8 million. We have earnings before interest and taxes of $6 million. And then we have long-term debt. And then we have a weighted average cost of capital of the two amounts, the 16.2% and a 16.42%. And then we have long-term growth. And this will lead you into what's on the next slide. But these are the assumptions that are used. The only thing that changed is the taxes, and the taxes impact on the weighted average cost of capital. Next slide. Okay, under scenario one, we start off with.
Hey, Eric, real quick, there's a question that just came in here I want to ask real quick for you, and that is in regards to looking at these, I'm just trying to summarize the question here. When you look at your scenarios here, when it comes with the sunsets and the extensions, could there be taking into account the fact that the Pennsylvania corporate tax rate is going down from 9.9 to 4.99, there could be a tipping point somewhere in here, with the fact of your corporate rate being 21% and your Pennsylvania rate being 4.99%, that in the future going to a C corporation could make the most sense anyways, no matter what, even if the rate's sunset or not.
Yes, it could. It could. Where it gets closer, if it's extended, it can make much more sense if it's sunset. But when it's extended, you have to factor in the dividends tax, which acts as a little bit of a leveling factor then too. But yes, it could. You definitely should model out and look at it. I mean, there's other reasons why someone would want to be a pass-through entity and a C corporation, as far as you're protecting your own personal assets and things like that. But it definitely could come into play, Dave.
Okay.
Okay, so we start out here with the same normalized income before taxes of 4.2 million. And under the sunset scenario, the taxes are higher because they're at 40% than the scenario 2, which are down to 29%. So you can see where we have a reduction in earnings after taxes. We add interest expense net of taxes back because we're valuing it the invested capital. So we add interest expense back. We just basically take the tax impact of the interest expense. Then we add back normalized depreciation because that is a non-cash expense. We subtract out normalized capital expenditures on both scenarios. So we get to net cash flow to invested capital, where there is a $660 difference between the two. And then we divide that by the weighted average cost of capital cap rate, which is the discount rate that we showed before, less the long-term growth rate. And the capitalization rate is 12.7 versus 12.92. And the two values that you come out to are $28 million and 32 or almost $33 million. And the increase in value is over 16% if the tax rates, if the TCJA is extended, because basically that's the percentage that you're going to be saving in taxes and the tax deductibility of interest expense. So, it's real dollar values and could be a significant impact going forward if it's extended. Now, we don't know if it's going to be, but right now, we're valuing things as if it's going to be sunset and the federal exemption is going to be lost, which I still think is the biggest impact of all. If that goes away, that we'll have the biggest impact, I think, on of anything. But you can see that the TCJA implications are can be significant. Are there any other questions out there, Dave?
Not right now, Eric. So you can go ahead and finish up.
Okay, next slide. I think that's it.
Okay. All right, well, right on time because it's 2:57.
Yeah.
I think that was a really good overview, guys, in regards to the changes to the, if the TCJA is extended or is not extended. I know that the biggest item that a number of clients that I work with are dealing with right now is related to the estate tax and what that is and what that estate tax exemption is going to be, whether it's going to stay at the 14.5 million and continue to go up from there, or if it's going to revert back to what it was in 2017, because that's probably the biggest item that at least I'm seeing right now. I don't know about you, Eric or Jeremy, but what is the bigger items here relating to the extension or the sunset of the provisions that you're seeing?
For me, that's the biggest impact. I mean, the rates going up has some, but losing out on that much or almost potentially $5.2 million of tax, that's a lot.
Right. Okay. Well, excellent.
I would encourage everyone, if you have potential taxable estate, don't sit on it. Move forward with an estate plan and get the valuations done while you can. The earlier the better, because I think we're only going to get busier as the year goes on.
Yeah, no, absolutely. So, all right, well, gentlemen, let's go to wrap up since it's almost 3 o'clock here. I just want to say to everybody on the webinar, thank you for joining us today for today's webinar. If you have any further questions regarding today's presentation, feel free to reach out to our team. Right there's our email addresses and everything like that. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CP and answered the polling questions, those certificates will be sent out within the next month. Just a couple updates too, a couple upcoming webinars that we have. April 24th, registration's open for our next webinar, which is our CMMC team. We'll dive into the state of CMMC today and where CMMC is heading, as well as shed some light on what a C3PAO looks like during a CMMC assessment. So yeah, that is C3PAO, not C3PO and R2D2. That is C3PAO. So a little bit different than what you would see with Star Wars. Although I think one of the presenters, Dave Hammerberg, and he'll make it very Star Wars-esque. We also have an upcoming set webinar related to SOC, Essentials of SOC 1, All You Need to Know, which will be taking place on May 8th. So feel free to register for both of those items and both of those events. I just want to say to everybody again, thanks again for joining us today, and enjoy the rest of your day.
Thank you.